Andrew Constantinidis with Jesani Wealth Management. And as part of our multidimensional asset allocation strategy, one of the core components is, of course, real estate, which real estate has been historically an investor favorite as an asset class to diversify their portfolio and have a non-market correlated asset that can continue to either generate the income that the investor may need to support lifestyle, or a combination of also capital gains or growth in the portfolio. So there's really two categories within that real estate segment. One is real estate syndication, and the second one, which I'm going to discuss today, is Reits, or real estate investment trusts. So Reits were actually created came about in 1960 through an act of Congress called the Reit Act, which at the time then President Eisenhower signed into law. The objective of the Reit Act was to really give your average retail investor access to investment grade and income producing real estate that at that time was really only available to really wealthy individuals, wealthy families, or in a lot of cases, institutions. So what has happened since then is real estate has become one of the three largest asset classes in the market. So the first one is, of course, fixed income, which right now has a total market cap of about $53 trillion. Second to that is equities at about $49 trillion. And then the third big one is real estate and commercial real estate, which right now stands at about $21 trillion. So after the Reit Act passed, also NAREIT was created, the National Association of REITs, in order to track REIT data and performance. And one of the questions that a lot of investors want to know is, how do REITs kind of stack up against the stock market over time? So I have a slide here that kind of breaks down and answers that question. You can see that they started tracking data in 1972. So from 1972 to 2019, the S&P had a total annual return of 12.1% versus the overall REIT index. So this was all available REITs on the markets, is 13.3%. So you can see the REITs did a little bit better by about 120 basis points, or 1.2%. But it really gets interesting when you drill into this REIT index and look at some of the different sectors of real estate and how they performed. So of course, different REITs are focused on different segments of the real estate market or geographic locations. But you can see, like we know self-storage really blew up in the early 2000s. You can see 16.7% in that particular sector versus the S&P at 9.3%. Of course, residential has done very well as rents continue to rise. Also industrial, so that's like your e-commerce warehouses, the real estate that Amazon is renting from REITs in order to sell their products. And then, of course, healthcare, which we know we have an aging population, so there may be some opportunity there. These are hospitals, long-term care facilities, or nursing homes that has done 13.4%. So what exactly is a REIT, or real estate investment trust? Well, it's simply a fund that's created and managed in order to go out, identify and purchase existing real estate, manage that real estate, collect the income that it's generating, and pass that on to the investors of the fund. And in a lot of scenarios, there's also an exit strategy from the fund, which could be to sell the entire fund to another fund at a premium, or it could potentially be to take, if it's a private or non-traded fund, to take it public into the public markets, of course, hopefully at a premium, which sets up a scenario where not only can you generate significant income from a REIT, but you also have the potential for a capital gain when either the investor sells his portion of the fund or the fund as a whole executes their exit strategy. Now, there's a few key components that qualify a corporation or a fund as a REIT. The first being that at least 75% of the investments in the fund need to be either in real estate or cash. The second one is that at least 75% of the income being generated by that fund needs to either come from rental income or mortgage income in the case that it's a mortgage REIT, which we'll discuss about in a moment. But probably the most important and most talked about is that in order to get the corporate tax benefit that a REIT gets, the fund needs to pass through at least 90% of their taxable income to the investors or the shareholders of that fund. Now, under the REIT umbrella, there's really 2 or 3 main categories, which can then further be broken down into different types of REITs in that category. But number one, and the most common and popular, is equity REITs. So this follows the example that I just mentioned, owns real estate within the fund, maintains that real estate, potentially an exit strategy. The second one is a mortgage REIT, which it's important to kind of distinguish because, of course, if a REIT is holding mortgages or mortgage-backed securities, that can be more interest sensitive than potentially an equity-based REIT. So, but within those, and then there's a third one also that can be a hybrid REIT. It's not very common, but that would be a combination of equity and also some type of mortgage or mortgage-backed securities exposure. So within those categories, you can also break it down between public REITs, private REITs, and publicly but non-traded REITs. So first, the public REIT. So public REITs is probably the most significant category with a total market cap of about $2 trillion. And public REITs are available on exchanges in over 25 different countries right now, which creates a scenario where you can certainly do a geographic macro analysis or top-down approach and really focus in on a particular country or geographic location. So one of the main benefits to a publicly traded REIT is it trades on the major exchanges just like a stock. So you have immediate liquidity at any day, at any time that you want it. Of course, there's a cost to that. They typically pay out a little bit lower yield, and also the back end or growth can be lower than a private REIT or even a publicly non-traded REIT. And also that liquidity can certainly be a downside because of the fact that it does change on a major exchange. That real estate or that REIT and that fund is going to tend to take on some of the volatility of the public markets, not REITs, but just normal companies that are trading on the public markets. So if the market is down 10% in a year, but the real estate market is not down 10%, if you own a publicly traded REIT, there's a good chance that that REIT is going to move more with the market and will have declined in value, even though maybe the real estate sector hasn't really gone down that amount. Also, another benefit is that there's really no minimum. A lot of the private or non-traded REITs have pretty significant minimums, some higher than others. But if you want to buy a publicly traded REIT, it's very easy to just go in. You can buy $100 worth. The other one is that they're SEC regulated, just like a public company. So they're reporting and filing with the SEC, which certainly makes it easier to do due diligence and provides for some transparency when an investor is trying to do an analysis on a particular REIT. So the second main category is private REITs, which, different than a publicly traded REIT, do not trade on the public markets. They typically have pretty high minimums. These are sold under a Reg D exemption, which was part of the Securities Exchange Act of 1933. But you're going to see lower volatility since they're not publicly traded on a day-to-day basis. So I want to kind of talk about a scenario that happened in 2020 where we had a lot of clients in it was actually a publicly non-traded REIT, somewhat similar to a private REIT, and COVID-19 hit, And we all know the S&P sold off about 30% at that particular time. So the publicly traded REITs on the market were down 30, 40, and sometimes even 50%. However, that non-traded REIT that our clients held was not down at all that particular month or quarter. Now, 2 months later, they reevaluated the assets, and it did go down about 7 or 8%. But at that time, we could redeem those shares at the market price, which it had done very well up until that point. Now, also, one of the negatives here is that a non-traded REIT or also a private REIT has discretion on redemptions. So you can't just say, I want to sell it today, and the REIT gives you their money back. There's typically monthly or quarter redemptions, and the fund always has the right to say, hey, we're not taking any redemptions right now for 6 months or a year, and that can certainly happen, and it happened in 2008 and 2009. However, we were able to redeem the shares for our clients, and then we created a publicly traded REIT model that we then shifted that money into at those depressed values. And of course, we all know what happened after that. Real estate did exceedingly well, even outperformed the overall markets in the recovery after the COVID-19 scenario. And that can kind of present an opportunity for a public but non-traded REIT, which does report to the SEC and is SEC regulated. However, it's not traded on the public markets and therefore not subject to a lot of the volatility that a publicly traded REIT might. So when you put together all these advantages and disadvantages, what does it really look like as far as a return from an investor? Obviously, if you're willing to sacrifice some of your liquidity or some of the transparency, you should get a better return, and that indeed is the case. So when you look at this slide, which is all of the income generating major asset classes, of course, equities at 2.2%, but as we know, equities are primarily meant for growth. Of course, you can get some dividend stocks, but the average is 2.2. The 10-year Treasury, which is one of the most conservative fixed income investments at about 2.6, might be a little higher today. Investment grade bonds, which is a very common asset class that investors use to generate income at 2.9%. Again, typically you have full liquidity there. But then the one I want to focus on is private real estate versus public real estate. You can see the average income being generated from public REITs is about 4.4% versus 4.8% from the private real estate. And that really shows you the cost of the liquidity in a publicly traded REIT, as you're getting about 40 basis points less. So these are some of the REITs that are available to investors. In the next videos, I'll kind of dive into the taxation of each individual REIT, some of the more detailed advantages and disadvantages, and also how to do due diligence or an analysis on a particular REIT. If you'd like to know more about REITs in general in the market landscape, certainly reach out to me. My name is Andrew with Jesani Wealth Management, and my number is 954-800-8552. Thanks, everyone.